Inflation appears to be slowing slightly, according to the Labor Department. Consumer prices rose 8.5% in July from 1 year ago. That's down from the high in June, when that rate was just over 9%. Energy costs have been driving the decline. Gas prices were down almost 8% from the month prior, but they are still up 44% from the same time last year. The market reacted to these numbers Wednesday. The Dow closed up more than 500 points. The Nasdaq rose 360 points, while the S&P 500 gained nearly 90 points. For more, I want to bring in Aaron Weinman. He's a finance correspondent for Business Insider and author of the Insider newsletter called 10 Things on Wall Street. Thanks for being here. So let's go ahead and start with stocks. Could this inflation data improve investor confidence on Wall Street?
Yes, look, definitely it has improved investor confidence. I will say, though, for today, we are rallying, but I think it's really because that inflation has been such an overhang for investors and for the market at large. I think what investors are thinking today is maybe the peak really has been put in the past. And just to put that in context, US stocks today, they capped a strong rally by roaring into the close, basically. The NASDAQ composite, the Dow, they kind of came back into bull territory and ended what was the longest sort of bear market since the financial crisis. As you alluded to earlier, the driver was the first soft consumer inflation report in several months. This development, it's egged investors in betting that softening price trends will allow the Fed to moderate the pace of the rate increase campaign that it's currently been on, and something that has rattled markets for much of the year.
Yeah, Aaron, you mentioned the softening prices. Is there a sense that inflation has now peaked?
I don't think it has peaked personally. I think the slowing rate of inflation, is due in large part to a decline in gas prices, but also drops in prices for things like used vehicles, airline fares, and also apparel. But it's important to remember that prices are still elevated overall in broader categories like shelter, rent, which you can argue that's the same thing, and food as well. So, for example, food prices, just pulling some data, it's actually increased 1.1% last month, and that's on top of a 1% gain in June. So for that reason, I think it's a bit premature to suggest that inflation has actually peaked based on this data.
And certainly when we're talking about, I was going to say, your two examples, housing and food are two staples that are inescapable as long as those prices continue to rise. Why are those costs continuing to go up?
So I think the short answer to that is demand. When you look at big cities, there is a big demand still for housing, right? I mean, there's a shortage of housing, and there are a lot of people that need homes. I mean, really simply put. And when it comes to food, we still have consumers spending at quite high levels. They're not what they were, say, 12 months ago, but they're still rather high. And when that demand is in place, that's going to keep the costs high. That's a very short, bare bones answer to your question, but I hope that makes sense.
Well, in basic economics, when there is high demand and low supply, prices are going to be high. One of the things that you mentioned that I want to come back to is how these changes in the economy will potentially impact the Fed's monetary policy. Do you think that they're going to continue to raise interest rates at the same level that they have in the last two increases?
Sure. I think at the same level is hard to determine at this point in time, because the Fed has raised rates recently at rather unprecedented, not unprecedented, but at very rare high rates, if you like. And with inflation remaining persistently high as it is, well above the benchmark target rate of 2%, another interest rate hike seems almost certain when the Fed meets in September. Whether those rate hikes will be 0.5 of a percentage point or 0.75%, it remains to be seen. But I think I would bank on at least a 0.5% increase. I think whatever progress we've seen, the Fed understands, and its goal is very clear, that it has to sustain this progress a month from now, especially when we get to the August CPI report. Otherwise, I think this will be quickly forgotten. So I think it's a little bit early to be revising the Fed's forecast based on a number that may not be repeated next month.
But 0.5 as opposed to 0.75 certainly would make a difference for anybody trying to buy a home. Aaron Weinman, thank you.
No, you're very welcome. Thank you for having me.